There are only three dimensions to build a wealth management firm: products through asset management arm, and relationship which leads to trust.
This is the hardest part of the founder's journey, right? Getting the first 10, 15 people on board.
The beauty of ESOP instrumented is that it is sort of asking somebody to co-create with you with an upside of an equity. The PhonePe has the best ESOP policy because it has monthly vesting post 1 year plus.
Ujjwal Jain founded WealthDesk, which was acquired by PhonePe to power its stockbroking platform. In this episode, he reveals how to hire right, design equity that actually pays out, and build a company people don't want to leave.
Build an IP, sell the IP that covers your seed funding, bootstrap it for as long as you can, get as close to profitability, then get acquired. It's a fairy tale.
Any mishires could actually even cost you your time and potentially your journey. Within 8-9 months, he realized that he's not meant for startup. He's not meant for that chaos. After that, I never hired a senior level tech executive for the company.
Looking back, would you think you would be better off if you had another co-founder through this journey? Anything you can share about what you're thinking of doing next? You're taking a break or starting on something?
Wanted to take a break, but AI is not letting because the way things are moving, man, crazy, man. It is like.
I know.
So I'm building in. So I'll be moving into private wealth management space and ultra-HNI family office segment from
Nice.
from a right now. So I'm looking to seed a platform, build a platform around solving two problems. 80% problem for wealth management industry. One on the workflow efficiency side, other on the autonomous intelligence side. And I really understand it, like both as a builder in the market and also now as an ultra-HNI customer. So it's a very, very interesting space to build and least innovation happening in that top of the pyramid in India. And yeah, man, top of the pyramid, there are only three dimensions to build a wealth management firm: products through asset management arm, and relationship which leads to trust. That's it. It's largely distribution through these three dimensions, right? Whether you do advisory or you do distribution. I'm a customer. I know every wealth firm's strength and weakness, right? As a customer, I've seen that. And the good part is that the most complex problem to solve, both on the workflow automation side, especially, it's a very high touch business and very high ARPU business in India uh, compared to, let's say, retail. So that's why it's a great place to build. And on the autonomous intelligence side, the cross asset and the dynamics of the product complexity is much higher to solve. And if you seed it right, you go into asset, then you go into hedge fund side. So that's a journey. See, I always take a bet with the at least 10-year view to build. I started in 2016 and I closing this chapter exactly after 10 years. So signing off with this, now moving into next. I think thanks to AI and high agency setups you can build now. I'm assuming the life cycle will be shorter to build. And maybe long. When I started in 60, I never thought that I'll be getting acquired like in 7 years down the line. So yeah, we're building with a long-term view. So that's the plan. Let's see. And might even evaluate going outside India now. This time.
Oh, nice. Okay. One thing on wealth, we keep hearing that there is, even in India, there is huge transfer of wealth happening from the previous generation to the next generation in terms of large families and so on. Is that like a good thesis to do something on?
So two aspects. So one is huge transfer of wealth is happening. It's actually, I think most of the folks who made a lot of money in their 90s and largely from 90s, 2000 onward, and the age range at that point would be in like 40s, 50s. So they are in their 60s or 70s. And their transfer of wealth is happening to a generation in their family which is completely digitally native. So that is one aspect where the existing wealth firms who have a very good relationship with these people are not able to build relationship with just like Shell because they feel like archaic and all of that. That is one. The other is the first generation of entrepreneurs who actually built in last 10, 15 years. They have generated a lot of wealth for themselves and like knew more better, like the ESOP wealth creation. And it is very rare. I mean, in my life, I've impacted so many people. It and the way I've seen in PhonePe, Flipkart group and all of that out. And I stay in in Bangalore, in an area where I have all the founders around. So, I have seen the growth of real estate as an ESOP, and in every ESOP buyout that happens in Bilandur area. So, I think India is one of the fastest growing Asian economy and largely global economy on the mass affluent and HNI and ultra-HNI space. So I think this is the time to build in this space. And it's the fact financial savings uh, was even a sort of a missing link even in people with a lot of money. They were also very traditional investing. So it's not just the retail investors have realized that inflation, if you have to beat inflation, you have to invest in markets. Even in the rich people segment, by now you cannot imagine South India, for example, there's so much of gold, land, and you will be surprised that even 100 crore portfolio might have very limited equity exposure, for example. So you can imagine, and that even at that level, the awareness is picking up that we need to be on the financial asset side. And India's story is especially the fact that as a young population, like 20, 30 years, it's a very stable economy to create wealth.
No, I 100% agree with you. In fact, as we raise money for our fund and my previous fundraising experience, I go to places like, Coimbatore is a great example, right? The amount of wealth, the amount of instruments, where this money is locked up. AIFs itself, one of the things that I quip about is this whole mutual fund Sahi Hai platform. We need something similar for AIFs. The education around some of these things has been so poor. If you are in the market, ins and out of it, then you know it. But the wealth is so much. Northeast is another area which completely surprised me. In terms of the wealth that is over there and how poorly that wealth is invested. Good luck. I hope you crack something new in this space. And I'll just continue the conversation. Quant is something that's personally as an engineer, moment you talk to anyone who understands and loves math, quant, moment you say quant stuff happens, right? So I would kind of want to hear your story about what got you into quant, and what led you to start the companies that you did in 2016.
So I am 2009 computer science pass out. Now there are two skill like interest areas which actually got seeded in my soul to say very early. So one is tracking market, which came from my dad. He's no more, but he's so obsessed about markets that even the day he died, he actually traded during the day.
Wow.
So while not a large corporate, very small trader / investor, but so I got exposed to markets during my school days with my dad. Growing up in Calcutta, you can imagine, Marwari family. Markets are very much part of the society in that part of the world. And 7th onward, I started programming. Class 7th, I started with GW Basic, the mainframe, COBOL equivalent programming language. From that, I moved to C, C++. Been programming for a while. So by the time I actually decided that I want to pursue engineering and I want to pursue computer science because I really love programming. I by third year, when actually people evaluate opportunities to do post engineering. So one is obviously I was very good in research. I wanted to pursue PhD, but I realized that I don't have the mental patience to actually pursue such a long, uncharted program. So I thought that why not I actually look for a career opportunity at the conference of computer science and capital markets. So it was so deterministic thinking that I applied the ESOP, which the US hedge fund, they used to come on our campus and they used to only hire computer science guys, preferably. Today, if you look at even today, Tower Research, all these big quant firms and HFT firms are computer science guys. So I was fortunate. I joined the ESOP in 2009. It was a dream job for me to unlock what computer science doing is to markets. In Wall Street, DShaw is one of the pioneers who has changed the paradigms of trading, right? And Vanessa, and there are so many names now. So I was fortunate to get exposed to that part of the world and the sector. And from that point, man, love for this intersection of computer science and markets have been just growing. So initially, I was solving a problem in our treasury space inside the hedge fund. Then D-Shaw did a joint venture with Reliance Industries, by the way, back in the day. So I was fortunate to join that as an entrepreneurial venture. I came to Bombay for that. And that is where I realized that Indian market has so much to offer. Like if you're a builder in this space, especially coming from a computer science world, not from traditional finance world. And the fortunate or the unfortunate part, the JV, the joint venture was doing well, but eventually it got shut down for some reasons. So I decided to stay back in Mumbai only and pursue something in India. But I was not confident enough. And you might know, you talk to founders, right? So the biggest challenge founders of our DNA, especially coming from middle class backgrounds, go through is that ability to take risks, that appetite to take risks. How do you give up a job where things are so good, where you have belief on some like areas that you can, the problems you can solve, but that internalizing that feeling that giving up a job, going into uncharted territories, taking risks is like, as a middle class, that unlearning is real. I mean, I think one of the biggest challenges for an entrepreneur in India, more than the idea or the problem you're solving. So I went through that escape velocity. Thanks to Mumbai city, it's a great city to liberate you to do good things. So I took like I briefly was in Morgan MSCI, Morgan Stanley Capital, the index arm, briefly during that period. So by the way, so there also I tried to solve building quant research or factor based index portfolios, which could convert into ETFs by institutions. So continue solving that problem within professional capacity, but eventually realizing that given that I've seen the DSO journey, the JV journey in India, I realized that I want to build something out of India. So I actually, the final escape velocity came and in November 2015. There was a hackathon in Bombay Stock Exchange. uh, I participated in that. It's a 36-hour hackathon. I solved one of the problems to that do basically KYC through Aadhaar. At that point, Aadhaar data used to come as an XML tags, not even JSON formats. So won that hackathon, came back. I got married also that year. So I told my wife that now it is getting easy. And I think the biggest barrier I have to break is that I have to believe myself and I have to give up this job, even though like we might have to see how we manage our finances after marriage, like first after marriage in Mumbai city. And I did have some salaries. So I finally quit my job in March 16. Now the problem called research is not what I started with, by the way. I started with a problem statement that I realized at that point, and today, by the way, it's so relevant even after 10 years, is that we ever create so many demat accounts as we expand. At that point, mutual fund SIPs were doing it around 30-35% CAGR. Broking account opening was going through a 10-50% kind of CAGR growth year on year. But at that time, online KYC,
Correct.
full online KYC for opening and broking account came out. Discount broking became a thing thanks to Firoza, the whole whole accessibility with great experiences at discounted pricing. That trifecta became key to discount broking model. So it was showing the green shoots that India, a lot of people will open up broking online. That was a very, very niche part. So I realized that we solved the difficult problem there till hackle when people think out. How can you lead some product in then open a broking account, they can do better in portfolio. That was the premise.
So you had a co-founder. Did you find somebody, or you started this alone?
I started the problem statement alone. Then I got a strategic co-founder, especially for the broking license to pilot the product. I got somebody who invested some money also, but also gave me broking pipe to fill the platform because I wanted a pipe to validate the platform.
So that was more like a partner, or was a co-founder who came, took the same amount of risk like you did?
He was a non-executive co-founder, non-executive sort of co-founder with decent equity. Yeah, but not exactly a full-time co-founder. But I definitely done art like strategic important engineer people and all of that. So take ESOPs, but somebody with decent equity and a non-executive way, that pipe and that access was very critical for me at that point. Right? To actually even like pursue that progress segment. Because if I would have gone to a large broker, for example, at that point, that largely the conversation at 16 would have been like, come join and bid with us. Right? Largely. Or he would have gone direct. Where I would have taken up booking license of my own and all that, but I didn't want to divert too much or expand the promise. So I wanted to just build this technology where I can open model portfolios on booking account, which are like management something. Right. So started building on that technology, got the broking pipe to pilot. The idea was simple that when people open their broking account and they want to build a portfolio on stocks, can I give them curated, research backed modern portfolios of direct stocks and ETFs? Or these portfolios will be built by SEBI registered researchers or advisors, licensed entities or fund advisors. So it was a two-sided platform. On one side, I onboarded SEBI registered research analysts, SEBI registered investment advisors to come create portfolios. And on the other side, I went to every broker and told that please integrate this platform on your broking consumer app and make this portfolios discoverable to your consumers so that they can be better with their portfolios. Because when they do direct stocks, it is not easy to make money. And I'll give you some stats. So when in India, let's say there are 20 crore demat accounts, and well, 12 crore odd unique banks have 20 crore demat accounts, but the number of people staying active during the year is just 3-4 crores, 3.5-4 crore, because many people make trading mistakes, investing mistakes, so they generally go dormant. But mutual fund, the things are very reverse. In mutual fund, there are only 6 crore families, 6 crore unique fans. They have more than 20 crore folios, which means when they start, they compound only and they invest more. Because there is a fund manager whose full-time job is to build a portfolio for you, whatever skill you're getting into. But of broking, it is like greed, complete like access to so much of noise, information, and FOMO and everything comes together when you open a trade on a broking account. So the idea was to can we bring a systematic product, sort of modern portfolio, which we call as dull baskets, or do that broking pipe. That's how I started. But when I launched my platform, I realized that most of the researchers I am talking to, especially broking research arms, they are all stock pickers. Now they're trying to take their stock picking strategy into a portfolio construction strategy, which is actually not a true science. Then what you will end up to some equal weightages to a certain set of stocks and just model portfolio. So that's when I realized why not, and that's coming from my MSCIDs also, is why not bring factor research or a quant research in modern portfolio strategy in India to retail investors directly. In Western world, that strategy comes largely through actively managed ETFs. But I wanted to skip that part because ETF for itself was very in early stages in 16, 17, 18, 19 also. Now, right now it has matured a lot. So I took that path. Let me set up a quant research company, take a SEBI research analyst license, and build a quant research stack. And first products I should launch up this quant research, this model portfolio on the web baskets.
And how long did this take from the start to getting to this point that you will do the quant research?
So 16 I started, 17 and 16 to 17 last quarter I launched the platform. So I was building only that period.
And how big was the team?
So this was around, at that time we were around like 15 to 20 engineering people.
Okay, and you were bootstrapped.
Yeah, I bootstrapped that time. Yeah.
So typically when one of the things, I think you've taken the hardest approach in some sense, right? Bootstrapped and also a solo founder, even though you had this non-executive founder and some relationships and some resources that came along with that. But typically, at least in my investor experience, whenever we look at solo founder, the lens has always been, there's so much shit that happens in the company. There'll at least two people required to share this, right? When people look at complementary skills and so on, for us, yeah, that'll be good to have. But even otherwise, the ups and downs are so much that you would be better off having somebody who's got similar skin in the game, and so on. Now, looking back, would you think you would be better off if you had another co-founder through this journey, or being a solo thing bought out something else that was advantageous for you?
So, two things. So one is, uh, if I would not have got a non-executive of the strategic investor slash a broker with a license where I can openly experiment with their consumers, I would have actually then would have find other ways to found a co-founder and maybe have taken the broking pipe at that point itself. So I did not take. The second part to it is that while I did not have a co-founder per se in full capacity, I built a team with a lot of curation. I mean, those people, by the way, my earliest engineers are still with me.
This is something I really want to double down on, in terms of how you built this 15-member team. Where did you hire them from? What were their aspirations? What did you, offer them in terms of either compensation, growth? Just walk me through this, because this is the hardest part of the founder's journey, right? Getting the first 10, 15 people on board. And now that, the fact that they are staying with you for so long means there must be something that you've done, which a lot of people can hopefully learn and repeat.
A couple of things which has really worked well for me, especially when hiring strategically, because these are like any mishires could actually even cost you like your time and potentially your journey can go through a lot of volatility, right? So the few things which has worked well for me even till date, like now, so one obviously I really look for the, the the person's character, the culture, from where they come from, what drives them as an individual. Apart from the fact that they have the skill set to join, and it give you some examples. For example, when I started building the engineering team for this WealthDesk platform, and the product is called WealthBasket. Uh, I never looked for the most senior engineering guy that I could get who has a lot of experience. Because at that time, by the way, I am also engineer, so I was hands on. Secondly, kind was coming on in a very very accelerated way to become the fastest way to experiment and deploy. So at that period, AWS is doing lot of workshops and all of that. So I always knew that if I get a guy who might be great at engineering, but most of these guys would have built in monolithic environments or like private data center. So, and I want to build a cloud native business, B0. So, and I'm also learning. So, I either look for people who are hungry, who want to, are very curious, and those immense love for markets. In the sense, they want to solve problems on the market. So, so when I took that as one of the key foundations for hiring, I realized that pedigree and all of that are secondary, right? But fortunately, I actually the people I hired with some of the folks from IIT Bombay, like my earliest engineering team in all IIT Bombay people. Like the good part with Mumbai in 2016 was that there were not many exciting early stage engineering problems to solve as in startups in Mumbai, because Mumbai was not that big on startup ecosystem, especially tech heavy businesses in 16 finally. So I was fortunate in with ID Bombay because they were doing prop trading. So they were actually trying to build their own strategies using APIs of brokers and all of that. They were experimenting, and these people were not enterprise style build.
On an individual basis, they were trying to do this as more like a hobby. And
Yeah. So they're working no individual basis, and they were working with inside the trading desk or broking.
firms. Okay.
Very, very, very sharp critical thinkers, great problem solvers, curiosity to learn. So some of these folks that I initially had were people who were trying to do prop trading but never built enterprise technology, and got them to join me. During this process, I also actually had a bad hiring, by the way, and that was also one of the learnings. Is that I got many C2 equivalent guy who I met in the past, and he was very clear that I wanted to build a startup at certain point in India. So when I got this opportunity, I moved him from UBS Hong Kong to Bombay. He moved, he moved there, he shifted, but within 8 9 months, he realized that he's not meant for startup. He's not meant for that chaos. He started feeling a bit unsettled. So he said that I'll move on. And after that, I never hired a senior level tech executive for the company, because the other people I had who were the learners, very curious, critical thinkers. They gave me the confidence that with them I can build this. Now, one thing that has worked well for me during this period was that it was an engineering heavy tech first platform business, and I was doing B2, B2C. So I didn't have this GTM thinking. I just need to be make sure that my platform, first of all, with my sandbox partner broker, can it works well, pilot well, and if I'm seeing the adoption, and if it works well, I just need to go out and talk to every broker. And being at Mumbai, it is easy to uh, get access to brokers. And coming from Disha, pedigree, etc., is helps by the way in Bombay.
These people were in typical what kind of experience range in terms of number of years?
They were around 3-4 years experience at that.
And was compensation a barrier? Because if they are in already in broking firms, typically, because I mean, obviously you're not a venture-backed company, so the compensation becomes a barrier in some sense, right?
The part where there's a lot of love for solving for capital markets actually helped initially when I was not able to pay them well because they were bootstrapped and everything, and we were not like venture back, so we could pay like market meeting salaries or even beating salaries. The other part is on the ESOP side. By the way, one of the things I have learned the hard way is to like have a very employee friendly ESOP policy from day zero. At that point, we were figuring out. Like we were in figuring out, and to be very honest, I think Bangalore fares really well on ESOP ecosystem in terms of understanding how this whole instrument, which is the biggest instrument we have, especially given the human capital we have, Mumbai was not that good, and I was completely not connected to Bangalore ecosystem, by the way. And whenever I used to talk to these promoters or CXOs in Bombay, like largely it was all bonuses and like there was this concept of giving a share of a company, right? Even the non-executive guy I was working with, the guy who gave me the broking, they never had this ESOP policy. It's a 70-year-old broking firm. So this was not even a thing. So I was learning on the go. Even talking to Silicon Valley founders and trying to listen. But I told my team that I need you guys to understand that once we frame the ESOP policy, while they joined with the commitment that we'll set up the ESOP policy, it took me a while to frame the right ESOP policy. But the fact is that commitment that we will be solving the best problems for the category. You love the category. Great team coming together. No nonsense, no ego, no hierarchies. Just solve problems for the customer. That all has, and obviously there's a salary component to it to run life better. That gave the retention. But the moment ESOP policy came, we did really well to make sure that we have the best compensation models. The part that these guys also started believing that we are working with the founder who really is hands on. We are very passionate to solving a problem with a lot of humility.
So what are one or two things that you would advise, today's founders not to do in their ESOP policy? Are there any things that you would look at and say these are universally bad? It won't help an employee. Is there anything people should avoid doing?
I think what should be avoided is having some sort of a conditional vesting cycles or vesting cycles which are very long, like in terms of let's say traditional vesting of, let's say there's a cliff period which comes from the Companies Act, which is 1 year. Post that, having clauses like vesting happens only after a year. I think that's not a good strategy because see, I'll tell you, the problem with ESOP as an instrument, the beauty of ESOP instrument is that it is a sort of asking somebody to co-create with you with an upside of an equity. But the taxation point of it is at a 40% ESOP, marginal tax rate, whatever is that, and which makes it more like a salary purchase, right? Not like a capital gains instrument which has 12% in long term. Now, so already there's this element of tax loss in the instrument, and while it is supposed to be higher as high reward instrument as an equity, so a vesting cycle which behaves like a salary should be a better strategy. Should be monthly or a quarterly is a good strategy. I think that helps people understand that the taxation part is 40, but we are making sure that this high risk component is vesting as you move along with this. So that's a good strategy to have. The second is generally start with a decent ESOP pool, because it brings predictability to your shareholders also in terms of their dilution, post exercise, vesting, etc. And secondly, it gives you that strength to actually hire really good people if they believe in your business, especially when you are growing at a pace which you never also imagined.
Right.
Because nobody predicts that, right? कब फटोगे पता नहीं है, right?
Correct, correct.
So if you and when you do that, you need really good people to work with you, high agency people to work with you. At that point, the ESOP is a great instrument, and today's founders have that luck, that for um, advantage that ESOP is well understood as an instrument. Like any years back, if you asked me, I was trying to figure out what ESOP policy should be. Today, if you ask me, I mean, who would talk to any person in Bangalore or Bombay? Everybody knows what ESOP could do to your life if you're aligning with the right company, a right founder, a right problem statement, and you give your time to that company. So I think the founders should use ESOPs in the best way, especially in a market like this where AI is transforming the way people do businesses, people build things. Human capital is the only like not a only talent, like it is always the most important thing in the startup. So I think founders should put a lot of impetus on a good ESOP pool, the right ESOP vesting schedules. Like in my case, when I got acquired by the day, I did accelerated vesting. It was not part of the policy.
Cool. Since you already brought up the acceleration and so on, in terms of, I know you were bootstrapped for quite some time. Then before you guys got acquired, you also raised a round of funding, right? So just walk me through that. Was that did you need capital and that's when it went that way, or was there any other strategy behind raising that capital?
Couple of external events happened during that time which were not controlled by us. One is the fact that we were doing B2B2C, but we realized that the growth expectations that we have or the impact we can have is not happening the way we want because we are relying on our broker partners to grow or bring the adoption to Wealth Baskets.
So your revenue was linked to the rate at which they are growing.
Yes, and it was not like a licensing fee. It was linked to the revenue of the product. So it was becoming ample clear that we need to find ways to accelerate that growth. Even though we are a B2B2C, at that point we can call SaaS platform today. You can't say even SaaS platforms to anything.
So this was an exclusive relationship. You have worked only with one single broker, or you had expanded to multiple brokers?
So we got acquired. We were actually between large discount brokers to mid-size to full service to regional to small brokers. We were integrated with 40 brokers.
Wow. Okay.
Long sales relationship with so many brokers in the country.
And the fundraise happened how many years before the acquisition?
It's the most interesting part. COVID happened. So it was like, so this is 2019, I'm telling you. 19 or 20. I just forgot. Now timeline windows are hazy.
Yeah.
So that time actually I did all the set up the company in a form where it can be ready for institutional funding. But before I ventured out to raise money, and COVID became a very important trigger because it gave that clarity that what we are imagining that there will be an explosion in terms of people financialize their assets and open an account or be very serious about investing. It became very clear that COVID will accelerate that move beyond first principles thinking was coming out very strongly that this is make or break event in 100-year of planet history. And we are in the digital space, so it is gonna be good only. So, the brief sadness of that lockdown finally really led to an anxiety. No, this is the golden moment to scale up, right? So I took a very small. So my friends and family also started saying that we also want to join your journey and all of that. But briefly took some money from them, and I immediately went out. But that money was there in the bank, so and we also had revenue, so runway was fine, manageable.
Were you profitable at that time or near profitable?
Yeah. Thankfully, marketing, cat and all of that.
I kind of didn't ask you this. I mean, did you have to put in a lot of savings to get this started, or you guys, because of this broking relationship, some revenue started coming in early?
I did not talk about the part where the savings was not enough to run such a big company, especially a tech company. I briefly worked before starting up or during that time. I briefly worked with a proprietary trading desk of a broking firm to help optimize some of their strategies on algo space, and got that impact led to me a very good outcome. I sold that IP, so that IP was in the upwards of 10 crore plus at that point. So everything got deployed in this.
I can see this coming out as a, some sort of a model way to do this, right? Build an IP, sell the IP, that covers your seed funding, bootstrap it for as long as you can, get as close to profitability, then get acquired.
That's my private equity strategy also. By the way, I invest a lot. Maybe we can segue to that part later, where I always build businesses with this mindset that my residual tech value, the IP value, should be meaningful, even irrespective how the business and the margins or the regulatory barriers are shaping up. Because that, I think, is fundamental to tech first businesses, especially if you are trying to patent or you are trying to build IP, which is not patentable, but it is very defensible mode. So that is something that gives confidence also, especially to bootstrap, because you know that every dollar that you're putting into the company is to build something really meaningful. It is not just to give it to performance marketing agencies to grow, and which can have variability. That's a great play. Obviously, you need to do it on the consumer side, but tech first company, the residual tech value makes a lot of sense, especially if you are taking it, you're going all in. But it's a very high risk environment. So that, I think I have done that multiple times now.
That's a very big insight and a very good way to look at it.
And you are a deep tech guy, so you will understand that building some of the most complex technologies across any domain requires significant investments on engineering side.
No, no, absolutely. In fact, one of the things that we keep saying in semiconductors is, ultimately, you will build a large company if you make the chip yourself, right? But for whatever reason, if the chip fails, the component IPs that are involved in making the chip is so valuable that you will sell the IP and still make enough money. You will not be a blockbuster, but you will still, so one of the things that's really important in, at least in semiconductors, is these component IPs could be like supremely valuable. So I'm glad something worked out like that for you. So anyway, so you did go out and raise money post the initial family.
Yeah, so 2018 when I launched, when I incorporated OpenQ, the quant research hub. So that also happened because I was so clear on doubling down on my IP building play, that I built the modern portfolio technology, let me build the quant research stack also, and build the entire value chain. So that was all money coming from our own pockets, plus the revenue. So, and this was in a separate company because it was a SEBI registered company. So in 2020, when I went out, I initially was talking to few venture capitalists, and I realized that most of the venture capitalists at that point were very clearly articulating that it is a great time to scale distribution, either through SIPs, SIPs, or opening a demat account, which is more like the first principle thinking for anybody to build a wealth business in India, and obviously grow zero. In these guys are like maturing very well at that point post COVID. So nobody was appreciating the fact that intelligence stack will matter at this point on top of broking, which has retained customers. Retention is a big problem, by the way, in 25, 26. Right? In 2020, nobody, venture capital didn't find that exciting at that point initially. But one of my peers actually raised a lot of money because they were backed by Zerodha, and they raised a lot of money at that point. So then my peer category comparison started picking up. So that was helpful. But the exciting point thing that happened with me is that I got money from a, a class of investors who don't invest at that stage where I am in, which is private equity. So I was talking to some Matthew Sirek, who is an ex Blackstone India head and now running Florian Tree Advisors. He has taken a lot of companies to IPO, but he invests pre-IPO mostly. He actually reached out to me for something else in markets as a true network to understand some public market company in our space. And when we were talking to each other, one fine day he told me that, Ujjwal, that deal is separate. That is something which I'm working on, but I want to invest in a company because I know the future potential of it. So And I think while it is too early for me, or it is in a decent step where I have predictability, but it is not large enough for a private equity check size, but I want to invest. How do we get this done? How, so that's how I actually realized that this is the most patient capital I would want at this point, because I want to continue building and at my own terms in my own way. So I closed a formal term sheet with him in around 2021, actually. Second half, sort of. And within, while I was, my terms got closed, my first tranche of money, I raised 25 crore with him at that point. My first tranche came around 10 crore. And that's when I also was integrated with many brokers and we were growing very well. I actually somehow got connected to PhonePe for, because PhonePe was evaluating the space, like getting into wealth space post their payment journey and in the BFSI side. And I pitched well basket and the whole IP I built. Like I never used to do a typical sales pitch. I used to tell the journey, like why we are building for what we are building, right? And somehow Samir Rahul got very interested. So it's like post the meeting, the next day Rahul was in Bombay and I met him and he told her, Ujjwal, we have cracked consumer distribution through payments. You have built a an IP which is really, really impressive and really, really long lasting to build a decade long like a long term business on wealth. Why not we come together in some ways? So initially the conversation started on some strategic equity or a minority stake too, and they started with that, and I realized that eventually my goal is to increase my distribution of the modern portfolios while I'm building the technology and the research. And PhonePe has a great distribution DNA on the consumer side. And DNA wise, we are both. I'm tech first founder, right? That believe in building long lasting technology to build great businesses. PhonePe, the foundations in PhonePe are built. Well, people talk about UPI, but right in the data center level, we invest. We have built the full stack, right? So very obsessed about building tech first companies out of India, consumer tech company. So that DNA match was natural. So that conversation from minority ended up in a situation, while we will not only want to acquire your model portfolio technology as a wellness company, we also want to acquire the research arm and take this full stack and you build the wealth business for us. So 21 and or 21, 22 first quarter, my first tranche was fully deployed or was getting deployed, while I not taken complete money from Matthews Laurent Tree. This thing matured very fast. And by August 22, we got acquired. The WealthDesk, and October 22, OpenQ got acquired.
So let's talk about the exit. How many people were you, and how was the split between the two companies? And I'm assuming the entire team moved to PhonePe, and both of these journeys like kind of converged, or they continue to run as two separate projects or segments inside post the acquisition.
The idea was very simple that so if you look at the wealth business that you've launched, the Share.Market or PhonePe, so we were very clear while since we were building in 2016 inside, how do we bring intelligence or value at scale, consumer scale, when people build their portfolio on stock booking and like through direct or CTF cannot.
Right.
And when we launched Share.Market in August 23, we are saying that today that as India, so basically on discount broking, while access and pricing with great experience has played a tremendous role to expand the market, but the next bigger opportunity lies in terms of how do you retain customers at scale, which can only happen if you provide real value. So that is where this market is expanding out across the value chain. Now even we are working on trading side. So that's how the whole we got moved into the setup, built the entire Share.Market stack, including the broking pipe, all the bells and whistles of the broking platform. All of that got launched in 2023. So today, wealth business runs independently in Share.Market, and the own team which required as part of WealthDesk OpenQ, plus the team that we built to run the entire wealth platform for PhonePe. All that is just one single team today.
So was there already a team working on the broking side when they acquired you guys, or you guys took over the entire thing?
It was very early at that time, like typically just evaluation, and it was a very clean slate to build the broking business. Mutual fund, we already went live on PhonePe when I joined. So it was already picking up. the mutual fund SIP. It was directly on the PhonePe platform.
So give me some happy story of people making money. Was this like a cash deal? Was this a stock swap? What was the mechanics of the acquisition?
The acquisition part of as of that date, whoever all the shareholders, including the ESOP holders with accelerated vesting, all got cash, including me and my co-PenQ, the other company where I did this other co-founder, all my people on the cap table. Everybody had it. Right, there was a cash value to the transaction. Everybody got the cash. The forward-looking part of it to build post-acquisition, like they were ESOP, PhonePe ESOP, which is PhonePe has this ESOP policy for of the leaders. So under that, we and the people who joined both the acquisition, everybody got ESOP depending on their roles and the area of impact and all of that. So that whole transition was we did very meticulously, and PhonePe has been a phenomenal company during the acquisition journey, where we all had this only mindset that every person in your company should be should participate and come post acquisition and build this together. So we worked really hard with each individual. Like a lot of these folks I had right by pre acquisition. Many of these folk initially felt surprised that Ujjwal, why are you getting a coin? Are you getting greedy? Is there allowing money since I'm getting a play? Oh, all of those questions I could deal with honestly, because most of the people were very high agency people. They knew where how we are moving, and they always knew that distribution is becoming is not getting predictable as a SaaS platform, and we should own the value chain, complete value chain. So when I talked about why I'm thinking PhonePe, it all became very clear to everyone. And PhonePe as a company is well known in terms of creating and building a high impact business. So and as a consumer tech company, so that understanding how when they move inside PhonePe, that their role will only expand and what we're going to build together. So those all vision I actualized with PhonePe and us, and help people understand what the post acquisition journey would look like. You should not get overwhelmed that I will be not needed if I'm from engineering or product or research or CX. Everybody, every individual, every person had a view that what it would mean post acquisition. So the transition was very, very smooth. Obviously, the other surprising part, we need to move, which came later as a news, that we need to move to Bangalore because PhonePe was concentrating everything in Bangalore. So that led to some collateral damage. I mean, they have sense even today. Then some of the folks, it was very difficult for them to move from Bombay. But 95% people moved. So 5% people stayed for some time working from Bombay office, but eventually they had to move on. Yeah.
So, and I'm assuming all of them had ESOPs as well. So wealth was not an issue. Wealth was taken care of.
Yeah, whatever ESOPs, but we gave as per our like ESOP policy within post acquisition, everybody got their exits. Yeah.
Yeah, monthly vesting, obviously all of that is one. And PhonePe is also known to do, periodic liquidity, right? So one of the things is, and companies that are cash rich, whether they're profitable or not, can really afford to do that in some space. But if you were to look at your stage when you were independently running the company, at any point of time, did you think, maybe liquidity could be done, or guys were really focused on building this into a profitable business? I know it would have been way early for you guys. It's very difficult to do any liquidity when companies needs to put it out of their own cash. Either they're very well capitalized or they are profitable. So in terms of now that you see 6 years, 7 years of independent startup, then acquisition by PhonePe and what PhonePe does, anything that you think you could probably advise a Series A, Series B company that could look at doing in terms of employee wealth?
I mean, if I'm being very honest, if let's say in 22, if I would not have got acquired, the people who were there with me since 2016, there was this continuous, in my subconscious, there was this continuous feeling that they need to see some
wealth,
some wealth, tangible wealth coming out sooner. So if a company is doing well, like in my case, see, a Series A and a Series B, like I prolonged my first institutional fundraise for long. So these people have stayed for so long. So in quarter two, when I raised the private equity round and immediately followed by a acquisition, if that acquisition would not have happened, 100% it was my responsibility that I would have to use some money from the cash reserve in the company to provide some liquidity and validation of all the high risks they have taken over a period. But companies which are in a very like meaningful fundraise cycle as a business, because the business needs that kind of money coming in and they are appraised in subsequent rounds, I think liquidity, whether it is not significant but at least something which makes sure that their market meeting risk compared to another established large enterprise, they are above and beyond that in terms of compensation by providing some liquidity. It matters a lot because that way, folks who want to continue that high risk environment, they know that the intentions are right to provide continuous liquidity. Because in some cases, it's not just that the money is 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 important, because it is important, but the equally important is the intention of the founders, how they are looking taking the company ahead. And I think in ESOP, what is undocumented in the intentions of the founders with their ESOP implement. And I think that is the biggest untold retention strategy, because people understand how the founders dynamics works with their ESOPs and their ability to raise funds and what they're looking in their from their employees benefits point of view. I think that intention comes out very strongly if you pursue that path to provide some sort of liquidity. And generally investors are, by the way, very open to this, especially if it's not too much to ask for in terms of providing liquidity. Then most of the investors really want employees to actually feel rewarded.
No, that's a great advice for a upcoming founder. One question on OpenQ. I mean, you had Sujit also as a founder. So how did that happen? Was he in the previous company and rolled over into running this?
I met Sujit in MSCI. He was doing research. He was a senior level researcher on the factor investing on the quant research side of MSCI. He moved from Provish, London. He was very senior. Like coincidentally, he's also my college school. He's from my same school, Calcutta. Quite, quite very old. He's 10 years older to me.
Okay.
So and he was in London for like I think a pretty long time, working in Deutsche Bank, and then he moved to India and joined MSCI. Tip MSCI over lunch tables, like, and used to like talk a lot about markets, research in general. So somewhere when I was looking to set up this quant research app, there were two names in my head I wanted to talk to. One was Sujit, and there was this another, I won't name him. And I somehow me in that said that on the part that he's culturally, I connect to him very well. He always used to tell me this anecdotally, like I remember like there were stories where he would tell that at some point I want to do something. But as small as that, maybe setting up an advisory app or something of my own. I have this kira to do something. And the fact that he came across very mature, very like committed person and super passionate about market, and gone into fully into quant because of the curiosity. As a CA, he moved into programming, like did coding and all that, and to build the quant research capability
Mm.
at that point. And after that, he had actually his wife was pregnant at that point. So I mean, he was in the middle of becoming a parent. So I'm bringing him with this like this vision, which I was always running in my head, and I was so clear about him because I was deploying technology on the one side, and I could see the opportunity, and I had to make them realize, feel it. It took me 8 months to convince him.
Wow. Okay.
The good part is because I was co-founding this other company which had a clean slate and nothing to do with wellness, I gave him a significant equity, like this equity to start as a co-founder day zero. Because in the salary part, he was earning a lot of money. Or, and then I decided that let's not burn that much cash. Obviously, you staying in Bombay, you need to want good life. So that part we negotiated very well on the cash component, which he could take, but the focus was more on the equity because I wanted him to like build this as a co-founder with me on the OpenQ side. I wanted that founder.
So, but WealthDesk was funding OpenQ in some sense, right?
Initially, we funded it because we needed to bootstrap it in a way.
Correct.
So Zelda's invested, I invested, even the non-executive guy from Zelda's also invested because he could see that Delphi. So we could net it. So that's how Sujit joined. It took me 8 months. See, on hiring and on talent, one thing I have realized the that especially if you are building a high agency company, it's like in today's day, by the way, in AI first world, you can actually build great companies with less number of people, right? It's not just the part that AI makes things efficient for you, but the fact is that high agency thinking is now accelerated now. And in that capacity, the ability to spend time with people on what you want to do together, not beyond the skill set and the competency part, I really am obsessed about it, right?
And you had a separate ESOP pool for OpenQ as well. And okay, and in the acquisition that got taken care of.
Yes,
Similar
everything.
to
Both
WealthDesk.
the companies got separately acquired in like with separate con sheets and share parts.
Okay, and Sujit continues to be part of PhonePe and is building whatever he's building. Okay.
He's the CIO of our entire wealth business, drives the research continuously, even he's right now, doing that.
But tell me one thing, there's a very general question on broking platforms as such. Given where Zerodha is, given Grow's IPO, Angel, and a bunch of things, do you see the broking world as kind of sorted, or do you see still opportunity for a new play? Because you have now PJ building done, and you have Sahi. People are still trying to crack something in the broking business, right? I mean, not necessarily the larger wealth business. That obviously has got a lot more players. But the broking business itself, where do you see that going? Do we have enough players, or do you still see the market absorbing more companies?
See, from like assuming that what makes consumer get into market, like whether from an expansion of market point of view, in terms of opportunity, I think the data is out there is a large market that is still untapped, because I think 12 crore family in plans only have demat accounts, 6 crore plans only have folios, mutual funds. So which means that there's enough room to expand the market. And I'm going whether it is the 25 crore population, or is it 30 crore, is it 28 crore, I don't know. Like estimating that. So in the opportunities that is out there, it, does that mean that a startup comes from that gap versus people who have great consumer tech and distribution and brand and equity? They are a strong opportunity to capture that market. So from that perspective, we also play in that segment. If you honestly, if there's any crazy founder with that very nuanced view to a certain problem statement can build a market opportunity for themselves, that is always there in any industry, whether it is a 10-year-old, 50-year-old industry. Somebody who thinks that, okay, I want to bring a trading platform which can do certain things, especially let's say with an AI first one, there are so many emerging interfaces. Somebody is an experiment. But I feel my 10 years of London building for Indian retail segment, distribution and brand trust matters a lot along with the product, a great product, because India is a very trust deficit country.
And especially in regulated entities, I guess it's even more complex.
The so ability to capitalize and brand trust platforms who are right now working on that space, they have a very strong opportunity to capture the incremental pie that is coming out of India. But I will, as a founder, I will never say that anybody who thinks that I'm crazy enough and I am, as a first principle founder, I can solve certain problems. It could be a difficult journey. It could take years to get people appreciate, but somebody can still build, right, for a segment like this.
How big do you think quant can be in retail? I know that's part of what you wanted to do with OpenQ and so on, right? Because I completely got fascinated by what happened during the GameStop episode, right? There was a big eye opener in terms of what retail investors can do to this hedge fund hegemony in some sense, But from what you see from Indian investor from the time you started, people, I mean, and I'm talking about a lot more in terms of irrespective of what income bracket they are in, more in the age bracket, right? People who are in the mid 20s to mid 30s. Do you see a different appreciation, different view of these people from a market perspective? Would this be people who would possibly be encouraged to engage in things like quant and not just getting into the market to buy one odd stocks or invest in, in an index or a mutual fund?
See, there are two, like very broadly, there are two kinds of people who come into market. So one is with the only expectation to make money, like returns. They don't care whether it is quant or technical or fundamental. Is they think that this particular trade or investment could create money for me, I'll do it. I don't care whether it is technical. So they are not appreciating the underlying research. They are appreciating the idea. So that's one segment. The other segment, which is DIY, do it yourself, they are very curious learners. They really want to understand what a technical does to a particular stock. How do I understand charts?
Correct.
So that segment is appreciating quant like much more than what it was in the past. So a couple of regulatory reasons to that also. So for the first time, SEBI has now fully formally documented a algo trading guideline for retail. With the first guidelines came in 2012, that was only for institutional direct trading access, direct market access. The a proxy to that was only used to create informal algo trading market in India. Now SEBI has formalized the retail algo trading. Like if you want to open ATN as a broker, if you open for algo player with a research analyst license can open an algo, whether it is quant based, technical based, all of that now is formally available. So if somebody, so from that perspective, the people, the DIY segment I'm talking about, they are really appreciative of somebody provides a quant research based portfolios, data, research, insights, so that they can build on top of that. That market is gonna actually explode from now on. It's in very early stages right now.
It's fascinating. I will catch up with you offline. There is so much to discuss, about this. But largely, yes, my intention was this to kind of understand how you build the company, the people, in terms of reward structure, what did they look for, and so on. So it's been absolutely fascinating, Ujjwal. Is there anything more that you would like to add in terms of the company building culture? Anything that will help founders who are looking to, grow their people, give them an opportunity to build something, and at the same time make sure that there is some wealth at the end of the day, because passion only takes you so far, right? You just want to make sure that, and you, like you rightly said, as long as the founder is of a mindset that I'm creating this value for everybody, and that's a great founder, to have. So, I mean, there's a whole bunch of stuff that are takeaways here. But is there anything that you would like to add?
People really love the founder they want to work with and the problem statement they're trying to solve. I think that if that culture is built set, I think people really rally along with you. But important thing is to find those people that who really want to solve problems that you're trying to solve. They really understand what you are telling them, and including the goods and the bad potentials that involve, and also how you are looking at your wealth creation life cycle, both like for the company shareholders and the people. Be very clear how the journey was. I think that participation helps in retention, because a lot of people leave company because of opaqueness, not able to understand what he's trying to do, or they don't have access to even be honest with them and all of that. So I think founders need to be approachable, not on the problems that they are trying to solve, but also the problems that they are solving in their head that the people can know in a transparent way, which can make some of the people can feel that, okay, this is something I don't associate. But that's a great place to be, unless if there's overhang that cost the company also, right? I think these are the things I really care about. I think even I made mistakes in the start where I thought that the problems are just for me to solve only, right? But is the more and more I matured and I got really candid with people I know, they want to build an agency company with me and they want to be part of my journey along with me and rally on the problem statement. I think that honesty with lot of humility, uh, humility as well. So, and obviously that predictability that, okay, there is a potential to create wealth. Initially very high risk, but over a period, the risk is only reducing. Yeah, we really appreciate that. And venture really get more trust from good institutional players. So that really was founders in that case. Bootstrap, that played a challenge initially.
No, I think, and there are examples like yourself who have gone through this journey and made it successful, generated wealth for so much. That will be an inspiration to a lot of other people to follow as well. So thank you so much. This has been, wonderful. I think our audience will have a fantastic time listening to, what you articulated. And I hope, you get to repeat it many more times, and good luck for the new venture. We'll talk about it a little later.
Yeah, thank you for hosting. It's a great setup also, by the way, to talk about these things.